Hello, this is Dale. I've been trading credit spreads for a long time, and it's a very conservative trading strategy. Credit spreads, you can win if it goes in the direction you think, if it goes sideways, or even if it goes against you a little bit. This is the method I use to consistently bring in profits month after month. A lot of my mentees ask me, well, how do you select the short strike price? And this is a very important topic because you can set up a credit spread at the money and it can go against you and you can lose quite a bit. So it's a conservative, safe trade, but you have to set it up to be that conservative, safe trade. I set up my strike prices to be a high probability trade, and I'm usually looking for somewhere between 75 and 85%. So let's go through that. Again, my name is Dale Brethauer, been a trader for greater than 4 decades, hedge fund manager, and I am the founder and stock option credit spread coach at www.optionsinfinity. I release alerts when I'm going to make a credit spread trade. I also get together with all my mentees every other Tuesday. We talk about the trades we have on, what I see in the future, what I see going on in the market, and usually we have a topic of education that I go over. I believe this is the very best website, educational options website available today. I go over this quite a few times. The advantages of vertical credit spreads are great. Okay, you get great returns coupled with high probability trades. It's going to yield monthly income. Now you're going to have losers. You're going to have losing streaks, but consistently month after month after month, you are going to take money out of the market and put it into your account. And there's no other trading method that you can do that. This is not a strategy to hit a home run. These are hitting singles. We're playing small ball. We're bringing in small amounts of profit, but consistent on a consistent basis. They're high probability trades. With credit spreads, we're selling premium. We are if you want to think about the casino, the house, we are the house when we are selling the premium. When somebody's buying the premium, they're the players in the casino. We're the house. We know that there's an advantage to being in the house. That's an edge. The beautiful thing about credit spreads is I don't have to chart hawk the market. I usually watch the market about the first thing in the morning I go into my study and I put together my plan for the day, and then I usually watch the market for the first hour when it opens. Usually come back and check around noontime, and then I like to watch the closing, and that's it. That's it. I know what my trades are. I know what I have on them. I know what to look for, and I don't watch the market all day long. It's low anxiety. And we have protection against loss because when we set up a credit spread, we're selling at a strike and then we're buying one further out of the money for protection. So we're not selling naked. Of course, we're using the theta decay or the time value decay if we're trading out of the money options, which is what I always do. There's only one value with out of the money options, and that is time. It's usually a pretty heavy premium, and that premium erodes the closer we get to expiration. Time is in our favor. Okay, so let's take a look at the recent trade we put on the RUT, and let's talk about how we determine the short strike price. The first thing I wanted to do is I want about an 80 to 85% probability of it expiring worthless. That's in our favor. That's a high probability trade. So I come down here and you'll notice that this is an option chain right from Thinkorswim. Most trading platforms will have all this information. I set it up so that I can see the probability of expiring worthless. And this is where I zero right in. I want to get a short strike price that's right in this range somewhere. Then what I do is I take the current price for RUT was 1775. And then I come over here, and based on the month that I'm going to set this up, I look at the implied volatility and the projected move plus or minus based on this implied volatility. I want to be outside that range. So in this particular case, I'm setting up a bear call. So I want to take the 1775 and add 175 to it. And for that, I'm going to come up around 1950. 1950. Well, let's take a look. Here's the 1950 strike price. And that's right in the range that we're looking to be to have a high probability trade. So 1950 is the strike price. And then to make it easy, if you come over here and look at this, it's going to be right around 0.2, somewhere between 0.15 and 0.2. It's the easy way to do it. You kind of zero in on a high probability trade. You look for a delta of about 0.2, because in layman's terms, delta of 0.2 is basically saying that has about an 80% chance of expiring worthless. That's a high probability trade. That's how I want to zero in on this. Okay, and so to set up the trade, what I'm going to do then is I'm going to sell. I'm going to sell the 1960, and then I'm going to buy the 1970 for protection. And that's going to be a 10-point spread here. And for that, I'm going to get about $2 credit. So that's how I go about setting up the short strike. First, I want to look for a high probability trade. Second, I want to go ahead and calculate what is the strike price based on the current price plus the probability of movement based on implied volatility. I'm going to add that for a bear call. I'm going to subtract it for a bull put. The other thing I can do is just come over here and look for a delta of about 0.2. And then the last thing I do is I go ahead and I select my short, go ahead and buy the long 10 points apart and to get me my net credit. This is showing what it looks like. We went ahead and we sold the 1960 and bought the 1950. So you can see we're quite a ways away from the current price of the RUT. This is a very conservative, high probability trade. We've got quite a ways for this to move in the opposite direction that we think it's going to go before we're in trouble. So with the credit spread, once again, if it continues to go down, and we think it will, we're gonna win. If it goes sideways, we're gonna win, and if it goes up against us but doesn't go up too far, we're gonna win. A very high probability conservative trade using setting up the short strike price based on implied volatility. I've been doing this for a long time. I've publicly released the alerts for 11 years. This is my equity curve for the last 2+ years. You can see, yes, we do have losers. We do have losing streaks, but we just want to stay with the strategy. And in the long run, we're going to have a nice positive equity curve and that's something that you can take to the bank. What I'd like to do is teach you all how to do this simple strategy. I like to keep it simple. If you just go to www.optionsinfinity.com, join us right now. If you join us and you're a member for 3 months, I'm going to give you the 4th month free. And the reason that is it's a very simple strategy. It's easy to understand, but it's hard to master. I'd like you to stay with me for a while to kind of go through some losings and some losing trades, losing streaks, and then come back and see how this works and be able to just execute these trades. That's why I'm giving you the 4th month free if you stay with me for 3 months. I hope you all join me, and I hope you enjoyed this video. Bye-bye now.